McGraw-Hill Professional presents The Income Factory, an investor's guide to consistent lifetime returns. Written by Stephen Bavaria. Narrated by Fred Filbrich. Introduction. Wealth without the drama. The message most investors receive constantly from their brokers, advisors, cable channels, and other business media is that success depends mostly on placing winning bets on the right securities. Then you have to follow their progress 24/7, always being alert to signs of trouble that may require you to bail out or change course at a moment's notice. Whew, that's a lot to worry about. No wonder so many average investors are stressed out and confused, or throw up their hands and buy overpriced annuities and other heavily promoted products and services that promise to relieve them of the angst and insecurity of investing for their own futures. While investing can indeed be all of that for many people, it doesn't have to be. I know because over the past 30 years that I have been actively investing for my own retirement, I have developed an alternative way to think about investing. This approach, 1, emphasizes things that we as investors have more personal control over, and 2, does not require such a heroic achievement in terms of earnings or stock performance as do typical growth-oriented strategies. I call my strategy the Income Factory, to focus attention on the actual job I expect my investment portfolio to do. That job is to produce a constant river of cash, that is income, in the form of dividends and cash distributions that can then be reinvested in new securities, whose job in turn is to provide additional income in the future. As that new income is reinvested and begins producing even more income, my river of cash continually grows. We discuss the math in more detail later, demonstrating how the cash buildup increases year after year at a fairly predictable rate, depending on the percentage yield our securities are paying us. The cash output from our income factory will double, then redouble, and then redouble again, continuously over the course of one's lifetime. A 10% yielding portfolio doubles and redoubles about every 7.2 years. An 8% yielding portfolio doubles every 9 years. A 7% yielding portfolio almost every 10 years, and so on. Notice I haven't said anything about the securities' market prices going up or down. That's because an income factory's output, that is the cash it produces, which is constantly reinvested to produce more cash, does not depend much on the growth rate of its individual securities, or even on whether they grow at all. Instead, it is the reinvestment and compounding that provides the growth in the income stream, not any required growth in the dividends or market value of the assets in the portfolio. The portfolio, of course, grows in value over time, not because the individual securities rise in price, but because there are more of them, as we use the cash we receive monthly or quarterly to buy more income-producing assets to add to our factory. For those of us who grew up in an investing environment where market appreciation was the be-all and end-all, embracing the income factory's growth without growth stocks philosophy can be a big step, mentally and even emotionally. To make the leap of faith required, it is helpful to spell out and understand how growth actually occurs in a traditional investment portfolio. First, note that the goal of most long-term investors, including me, regardless of what investment strategy we follow, is to earn an equity return averaging about 8% to 10% per year. We picked that target because 8% to 10% is approximately what returns on stocks have averaged over the past century. Some equity investors do better than that, and others do worse. But if someone can match that average or even come close to it over a lifetime of investing, they and their dependents, and eventually their heirs, should be pretty happy later on when they reach and surpass retirement age. The big question is how to achieve that 8% to 10% return. Return, or total return, as it is often called, has two components: cash received, dividends or distributions paid by your securities, plus market price appreciation or depreciation. Cash received is real. Market price appreciation or depreciation is theoretical, paper profit or loss, and only becomes real when you sell the security and harvest the gain or loss. In traditional investing, you buy stocks that typically pay dividends of anywhere from
Sample complete. Ready to continue?